Yeah, welcome to Macro Pillars on the 13th April, those who've joined us and those listening back. And yet again, a lot to cut through, and we've got a bit to cut through today. Did a lot of work on liquidity. The guys did a lot of work on liquidity last week just to try and understand the rally and the why behind it. We have spoken at length about the significance of probably certainly the most experienced financial practitioner as Treasury Secretary. And it appears he's using his experience from the evidence that we've been able to find. So, all the pillars, as we discussed, were very strong risk off, and from geopolitics clearly to technicals to liquidity. And obviously, from the technical side, it's not as damaging, but still, I would argue, is still damaging. And liquidity is better, but again, driven principally by the move, but also, as I've sort of termed it in the long form note, the hand of God has been hard at work. I'll touch on that shortly in more detail with Nick doing a bit of a deeper dive. But as you can see through the weekend headlines, it really is it's blown up again, if you like. The advanced trip to Pakistan, no deal, and the comments recent just come out of CENTCOM. Forces will start blockade of all maritime traffic entering and exiting the Iranian ports. So it's back on and it's elevated. And what I will show though, we had close to a 7% rally from the lows in some assets. But as I've drawn there's two lines there. One is the 10th of December, which is the QE date, the 40 billion coming through per month, which we'll touch on shortly because that's about to be significantly reduced. And the 2nd of March war date, which I think comes in around, well, I know it comes in at 69.11 on the S&P, and I think we closed last year at 68.98. So while we've done a lot of work, and as we saw in the last week or two, a lot of people out there that sort of do similar stuff to us but do it differently finally turned short yesterday, say last week, say. We've been that way for some months, and it certainly caught the market off guard. We'll show why shortly in terms of how the liquidity has been deployed and used aggressively. Aftermarket, no surprise. You have oil up close to 10%, gold down 1.3, equities are down about 1.5 to 2%, depending where you are, and crypto's finally taking some pain. So the market, it opens in an hour or so's time, will have a difficult start to the week. Macro overview, well, government and geopolitics clearly remains the same, if not more elevated. Global liquidity has to go back to neutral, as we'll show shortly. Again, only driven by a few factors, actually. It's been driven by the move, but the move has been fundamentally impacted by the way he's deployed the Treasury General account, and he's deployed it with quite significantly. And obviously, we've had that 40 billion a month as well coming in from the Fed. So that's been able to catch the market off guard. The market probably got a little over its skis. I don't think the Treasury Secretary was happy with the move at 115 and certainly wasn't happy with the markets putting in some pressure. And so, as we'll show shortly, how they deployed it, the guys did some great work as we spoke to and wrote to in the long form note. Volatility market structure, again, it's been a factor. It is this deployment of the TGA. It is the deployment of the cash account. It is the 40 billion that they deployed from December using the April tax season as the excuse and the reason. But what it has done is it's reduced volatility across almost all assets quite significantly. And the main one, which we focus on through our liquidity models, as you know, is the move, and it's come down from 115 to 72. As I said, he's been tirelessly at work to get that market calmed down. And we're now watching it a lot more closely because we've got the dates now in terms of how he goes about it. But once he's deployed it, with the Treasury statements, he needs to take that back out by the end of this quarter, back to around 900 billion. Again, we'll go into more detail shortly. Factors affecting liquidity. Again, it's the move. It's improved significantly, as I said. Don't forget, we've got the QRA coming in at the end of this month. So we'll have to have a look what he chooses to do there. I'm sure it'll be dependent upon how the market is responding. But again, overall, we still remain in that risk-off phase, albeit it was a very, very strong rally. You look at the Treasury, some of the balance sheets and some of the factors and some of the liquidity profiles and prisms we look through. The Treasury General Account, as it sits there on a year-on-year basis at 686, up 117%, 107%. Actually, on our models, that's liquidity reduced. This time last year, it was close to 360. If remembering, when you take money into the TGA, which is basically the Fed, the Treasury's banking account, where they pay their bills and receive their assets and receive their income from the taxes and so forth. As they deploy it, it's risk into the system, and as they take it out, it's risk off. And the balance sheet, which we'll continue to watch very closely this week in particular, because in the Fed minutes, as we'll note shortly, they had said they will significantly reduce the QE, which they've bumped in on December the 10th to assist the tax season in the United States. So I'll pause there. Nick and Matt and Nick in particular did a lot of big work into how the Treasury does its work through the buyback schedules, the Fed's 40 billion, the RMOP is the 10th of December, and the cash account is the TGA. I'll let Nick speak to that, and I'll add anything if required. Nick.
Yeah, sure thing. Thanks, Andrew. Yeah, so it's definitely been a big few days of learning, the rally prompting that deeper dive into what's really been going on with the plumbing. Of course, we do pick up these measures through our models, as AP said, through the TJ and the balance sheet. But what we're looking at here is the schedule to which these operations play out. So over here, we're looking at the Treasury QRA buyback schedule. So we'll be receiving a new one of these shortly. And then this is the Fed's Reserve Market Operation Purchase Schedule. And we should be receiving another one of them potentially in the next 24 hours. And there's a quote here from the meeting minutes recently. The manager noted that after April, the monthly pace of RMPs was likely to be reduced significantly as swings in non-reserve liabilities were expected to moderate. The adjustment was likely to be somewhat gradual. So it's been at about 40 billion a month. You can see the max operation size for the RMOP has been from 6 to 8 billion. And we'll look at some charts shortly to show you the points in which they were coming into the market. And then for the Treasury QRA buyback schedule, it's important to note that there is nuance between these operations. So there's cash management purchases and then there's liquidity support. And I'll do a quick explainer of them in a second. But what really prompted me to start looking at this, or prompted us to start looking at this, was that these cash management purchases of 15 billion, they are the largest in history. And this has only been something that the Treasury has been doing since 2024. And it's definitely been much more effectively used since Besant came into office 28th of Jan 2025. So yeah, these are the largest cash management purchases in history. And then the first two came through and they were fully exercised at their maximum purchase amount. And that coincided with the market bottoming as well. So that kind of really drew my attention to it. And then on the 1st of April, 31st of March, that clear market bottom, it was just, yeah, it's clear as day. We have to look into this a little bit further. So I'll just cover what each purchase is so that we have a good understanding. So the cash management purchases are when the Treasury buys back short-dated bonds to smooth its cash balance and reduce swings in bill issuance. So they can help calm the move because they smooth reserves, smooth front-end supply, which calms the bond market and reduces funding stress. So the liquidity support purchases. That's when the Treasury buys back older, less liquid bonds from the market, and they support equities indirectly by improving Treasury market functioning, but also easing dealer balance sheets, reducing rates volatility. And then the RMOs are purchases when the Fed buys treasuries to keep reserves ample in the banking system. They support liquidity more directly by adding reserves, easing money market stress, and helping keep financial conditions more stable. So they're all liquidity supportive, but the cash management purchases are more so to calm volatility, specifically in the bond market, which is obviously a huge component of our liquidity models and market volatility in general. So these are the results of the current three previous cash management purchases of 15 billion. So you can see that the maximum amount to be redeemed was 15 billion. And then the maximum amount offered by the market was 40 billion, and the total amount accepted was about 15 billion. And that was on March 10th on that low, and then the same thing, but we're maxed out on the 17th and then on April 1st as well. So this is really what prompted us to take a closer look. So if we look here, right, these are all of the cash management purchases in history from the Treasury. So this is on the left side of this black line is before Scott Bessent, and on the right-hand side of this black line is after Scott Bessent. So you can see that, we started with 5 billion spread over four purchases, and then we had a few small purchases here that weren't very effective. And then once Bessent came into office, here in this period, we have tariff, we have Liberation Day, we have 8.5 billion times six with a smaller purchase here, totaling 53 billion. And I mean, the chart speaks for itself, right?
But that's just to be clear, that's the move.
Yeah, this is the move.
And so the green lines, green arrows are the purchase dates. So obviously, as the move goes up, he's adding liquidity into the system, and that has since just settled down the move and settled down broad markets.
Yeah, absolutely. And then here, and obviously this is all planned forward ahead. So they released this schedule and the date at the start of the quarter, right? So which is also interesting. Um, we've got a few more here as the move was kind of decaying. This is actually the period where the arm up was announced, and then yes, this is the recent period. So we've had three so far of 15 billion, largest in history, and the total amount in this period will be 75 billion of cash management purchases. So the question that we need to ask ourselves is where would the move be in these instances without these cash management purchases? And obviously, these purchases are being used very effectively between Bessent and Trump as to when Trump might want to make a move, you know what I mean? So,
And obviously, you can use that. I mean, we're using the move because we think it's the most significant volatility indicator for the market, the bond market. But it obviously impacts a calmer move will help the equity market. And obviously, the market's a little over its skis like it was last week, and he's putting a lot of money into the system. You saw what happened.
hmm. So this chart has all of the purchases displayed essentially on the chart. Now, there are actually more smaller, less significant purchases included, but I've removed them to just kind of focus on what's really significant. So in green, we have the cash management purchases of 15 billion. So you can see here the market made a low, then we rallied, we come down, market made a low, and then we made our ultimate low with that purchase as well. And then the purple arrows are liquidity support purchases by the Treasury, and they're ranging between 2 to 2.4 billion in this period of time. And then the blue arrows are the RMO purchases of between 6 and 8 billion, essentially. So it's estimated that been over 200 billion. It's actually more than that, right? So probably 250 billion from the TGA and 40 billion per month from the Fed. So in this time period, supporting the market. And then, of course, we had the war risk being priced out with the ceasefire, right? The de-escalation, which helped the market lift for sure. And then there's another good period of time to reference is Liberation Day last year. This time last year, it's the same thing, right? It's tax season. Um, Green is cash management purchases. As we said previously, there's more of them, but they're at a lower volume. And then the liquidity support, there are more of them as well, but they're at a higher level because there is no RMO there helping the market as well. And then, yes, this is the TGA. So of course, all of this is drawing down on the TGA, right? To make these purchases, he has to draw down the TGA, as in Treasury Secretary Besant. And they've indicated that they need to rebuild that TGA back to 900 billion by the end of the quarter. And this week we'll definitely be doing more work as to how they will rebuild that, and if we can figure out if there are dates associated with that as well.
Great. Excellent work. So look, in summary, I know a lot of there's a lot to take in.
Mm.
I mean, he's effectively trading the market, and he's got a big balance sheet, certainly a bigger one than mine. So we need to be across what he's doing, and he's deploying that at the times when the market's in stress. So our role going forward will be to look at the schedule dates, and we'll do more work on that. And when do they come out, Nick, the schedule dates?
So the next one for the Treasury will be at the QRA, and then the we could be getting the next RMO schedule either today or tomorrow.
Yes, the RMOs from the Fed in terms of how that $40 billion may be significantly, although they said gradual wound down. So that's going to be liquidity out
Hmm.
on a rate of change basis. He has to get, okay, it's only early in the quarter, but he's down at 690 on the QRA. So he needs to get that back to 900 by end of the quarter. So he's deployed and he's done a good job because he's got the market back near its highs, but not through the 2nd of March. So interesting, and the market's going to obviously open lower. So, and then we're going to do some work on, which we've only, because there's obviously a lot of work there, as you can appreciate. We'll do some work on what happens when he does take it out. And we'll go back and look at those dates and we'll update during the week that information. We'll incorporate the timing. Be mindful. I mean, these are in our models. The TJ's in our models, the moves in our models, but we just weren't looking at the dates so aggressively and how he deploys it. And clearly, if the market's starting to lose its structure, its footing, for obvious reasons, he's obviously gone to work because he needed to calm it down. I'm sure his boss was knocking on his door to do it too. So at the same time, he's going to have to trade it the other way. So as we see from the market opening, it's going to be stressed. Conscious of time and appreciates, we'll just quickly go through, get to Brian, because I know guys are very interested in the ags. Quickly, that's the Brian eggs slide. I mean, again, as I've said, that's still a chart that I like a lot in terms of long ags, short the equities. In terms of the way I trade it technically, I still want that market back under that lower bar. And a lot of those outside range quarters we showed you last week, they had come back through it, but it's a quarter. So once it comes back through the other end, you're back into the game. And I'm watching the 2nd of March on almost every asset to see if it can confirm. If it confirmed and there was a liquidity support, we would have to change our view into the market, but that hasn't changed. We remain very much of the same view, albeit last week was a strong rally. Brian, go for it, my friend. Brian, you're on mute, mate.
Thank you, Andrew. I apologize for that.
All good.
The current macro pillars eye on agriculture reflects a market that's not yet pricing a true supply shock, despite a supportive macro backdrop. Corn and wheat remain in a carry position, indicating that no immediate stress, while soybeans show an inversion, pointing to tighter old crop conditions and near-term support. Within the optionality of the markets, wheat stands out as the highest volatility and the steepest skew, positioning as the primary geopolitical hedge, which has been our position for some time, and you just spoke to, while corn reflects a moderate upside risk and beans remain relatively complacent with respect to volatility. And from a positioning standpoint, we believe that corn and soybean are crowded longs and vulnerable to liquidation under tight liquidity conditions, whereas wheat is relatively clean, offering a more attractive asymmetric upside. Although balance sheets do appear comfortable on paper, the combination of energy shocks, trade disruptions, and rising input costs for farmers suggest forward risks do remain understated. And as a result, we're staying true to our long ags, short equity conviction specific to wheat and corn. And we want to point out that that liquidity windows, they're fundamental, that could drive these sell-offs and present opportunities to uh, add to your long grain exposure on this weakness, or to um, look at a potential play of seasonality if this occurs later in the month and closer to May.
You're just on that because you raised a good point last week that so the seasonality for the ags and wheat start to get better in May. Is that right?
That's right. Traditionally, the last week of April, first week of May starts a seasonal sell-off where uh, positions are. The market begins to bake out the premium that's been built in as we become more defined in crop condition and planted acres.
I mean, I'm long wheat, and just looking quickly at the chart, and I'm using a. But the 23rd of June was when they went into Iran the first date. We went above that and closed above it. We just snuck back below it, but I'm not concerned by that. And we're still remaining above the 4th of March, which was the low after the 2nd of March for the wheat, which is at 560 on the Australian. I don't know what the wheat price is, but
And
is that
they're all floating around that
well,
date.
yeah, yeah,
Yes.
exactly. So they're the levels that I like. But again, to seasonality is critical on ags, as most know. So keeping an eye on that is great. Just quickly, thanks, Brian. Anything
That's-
further?
No,
Okay,
thank
good.
you.
Thank you very much. Just quickly on this, on the technicals. As I've said, there's the DAX came through the outside range quarter. It's still below the 2nd of March, so it'll open lower today, and if you can get some acceleration back through that low, then that trade is still well and truly in play. The next chart is Japan. That's oil inverted. So as the red line goes down, that's oil going up. Um, sorry, that's not oil inverted. That's oil. That's the oil just normal price. Um, and then basically, no, let me start that again. The yellow line is oil, and it's trading at $96 as of Friday's close. It's obviously a lot higher. And the red line is as it goes up, you'll be short Nikkei and long dollar yen. So as you can see, it's been a good relationship since the war started due to the energy dependence Japan has. And obviously we had oil price, which will go up. That is the yellow line going straight up. The red line, I suspect, will have to go back aggressively as well, which is again long dollar yen, short Nikkei. So those energy dependent names remains where we are. And the last chart, just that Aussie US chart as well. We've spoken at length about the concerns around what's going on in Australia. Again, it's back at the '08 highs, and it's got that outside range lower month and quarter, which will come back into play if the market sells off. I will pause there and get Stephen's thoughts and observations.
Good morning, everyone. Hi, Andrew.
Yeah,
Guys, I'm sorry, I've got a heavy cold, so
no worries. Well, sorry,
but
sorry to
I,
hear that.
I do want to just commend uh, Andrew and Nick for that move analysis. I don't know if people realize how significant that is, but
Yeah,
essentially my thing is uncertainty, and most uncertainty is certainly captured by
yeah,
volatility indexes, and essentially you guys have
mm,
model that uncertainty with your chart there with the the movement of reserve management purchases and other bill
mm,
sales and ups and downs. So that's really phenomenal. It shows you the extent of fine tuning that's occurring. It
mm.
also begs the question, where'd the volatility shift to, guys? You
Yeah,
know, because if you're pushing down somewhere, it pops up somewhere else,
yeah,
whack-a-mole. So
yeah,
it's pushing into the bond market. It's playing with prices in bond markets, which is then reflected across the whole asset complex.
yeah,
It doesn't extinguish, it just shifts.
yeah,
It's playing with prices, so keep an eye out for that.
yep,
And of course, you're looking for the reverse, what happens on the other side of this.
yep,
Of course, they've timed it exquisitely, so that's some period away. They've bought themselves some time, um, which is really clever. You just got to admire these people. I mean, one day their central management of asset prices is going to come back to smack them, but not today, perhaps. So very clever. A little update on Australia.
yep,
Resource-rich nation with massive reserves. Um, um, uh, Travels around the world begging for resources and capacity. So not sure what that means, but I'm sure that comment will help keep me out of the budget lockup. So that's all good. Um, and guys, just further to Brian's portrayal of the sort of commodities, the grown commodity sector. Of course, it's the flip side in Australia. So as we head into the winter months, crop production becomes much more uncertain. We're in a sort of a 40 to 50 day critical period now where we can't get diesel, or we don't have diesel to do transport, to sow crops, to move stock to abattoirs and so on and so forth. So the whole thing is getting critical, sort of as you get it closer and closer to Anzac Day, especially in the southeastern states. The whole production cycle is being upended, which then will play out through spring with lower production overall. And so that will impact the pricing cycle. So just some thoughts there.
Yeah, great. Thanks, Stephen. No, we have Australian employment and inflation monthly data this Thursday, so that'll be a big number for the RBA as well, both their mandates on the same day, with all the other challenges going on, as Stephen's indicated on many occasions. Thanks, Stephen. Scorecard first, and then currency corner, please.
Sure thing. Thank you. All right, so obviously throughout the week, the stocks were pretty lifted in that 1 week ago change column. We have had some pretty large increases in the section. Leading, we have the Nikkei, followed by the FTSE, positive 35, positive 23. Then lagging the section, we've got US stocks, the S&P, the Dow Jones, but still scoring positively. But the ultimate lagger is the DAX at a negative 13, while still gaining 6 points on the week. For the bond yields, leading, we saw the Japanese yields, the 10-year and the 2-year, at a 47 and 45 score. So they're both the highest scores on the scorecard still. And then lagging the section, we have the US 5-year and the UK 2-year. So there's not really much change in the yields again for at least the third week, still remaining elevated. Obviously, we've got bullish alignment, high conviction through the pillars for all the yields. For commodities, leading, we have gold at a positive 25, followed by oil. Oil will most likely overtake gold this week, depending on how things play out, right? And then lagging, we have platinum scoring a very neutral 0. And notably, for the commodities, copper had a huge increase. In fact, I think it's the largest increase in the whole scorecard this week, up 38 points. Typically, when this happens, you've pushed through a yearly close and a cluster of dates around that level, and that has been the case for copper. So for the ags, leading, we have soybeans at a 14, and then lagging, we have cocoa, and in particular, we have sugar at a negative 29 material bearish score, and the largest decrease on the week, also selling off, pushing through its yearly close quite hard throughout the week. And then leading for FX, we have a dollar yen and the Aussie dollar. And then lagging, we have dollar Sing with a negative 34 decrease, quite material. And dollar yuan scoring a negative 36, maintaining its a laggard position for the section for the last few weeks. In crypto, same story really. Obviously, it's going to cop it a little bit more this week, but being led lower by Ripple as the weakest with a negative 22 score. And Bitcoin leads at a negative 7. And the whole section actually was a little bit lifted with the rally last week as well. For the sectors, leading, we have the utilities sector and the materials sector with a positive 31 and a positive 27. And then lagging, we have the XLF financial sector and the consumer discretionary sector with a negative 11 and a negative 13. But all up, the sectors remained fairly strong actually in this current period. And then for the countries, we've got the Brazilian and the Australian ETFs at a positive 36 and a positive 34. Then lagging, we have Europe and Germany. Germany, the only bearish score in the section with a negative 7, in line with the DAX leading the stocks lower at a negative 13. If we look at the 1 week change column, we have copper, NASDAQ, the ASX, the pound, the S&P, and XLK. And then they're the largest increases and largest decreases. Sugar, dollar Sing, as we spoke to, the Dixie, corn, dollar Swiss, and wheat. That's all. I'll pass to Matt for the currency corner.
Thanks. Thank you.
Thanks, Nick. Thanks, everyone. Spoke before me this morning. Looking at the currencies, the Kiwi and the Aussie were the strongest on the week. They were obviously hit the hardest after the initial global energy shock came through the Iran. Specifically on the Aussie dollar, we had the IB rates eased by 8 basis points on the week. And as Stephen alluded to, we've got the employment data coming up this week for the Aussie dollar. The yen was particularly weak against major peers. slightly stable against the US dollar, but the US dollar was extremely weak on the week as well. In terms of news on that one, they had 122 trillion yen budget come through in the week, and the 10-year Japanese yields closed at their highs, as well as the euro yen closing at 186.85, which is around the recent election date high, and it's the highest weekly close since 1990. In terms of US dollar against the Scandinavian pairs, they obviously stood out as well. You've got this SEK, CHF, and the dollar NOK as three of the weakest on the week. Oil-rich Norwegian currency has been the second strongest year to date, and all three of these have been unwinding a significant NIIP position, which we've spoken to in previous weeks as well. Looking at the pound and the euro, they also bounced off oversold levels. Both UK and European gas prices calmed down after the announcement of the ceasefire. Again, this will probably head higher today, put them back under stress, but both the ECB and the BOE have hikes priced in through the end of the year, and their growth forecasts are less than 1%. BRL was another currency which we've been looking at this week. It hit cycle lows despite softs pulling back. The real continues to benefit from demand for global tangible assets and stabilizing political regime, targeting lower inflation. That's it for the currencies. Thanks, guys.
Thanks, Matt. Okay, so the week ahead, and long form. A note from last week: the auctions in the US didn't go well, so we're keeping an eye on that net international investment position and seeing whether the dollar comes under any pressure, and bond markets in concert with Europe and Japan and even China divesting out of US bonds. The Iraq, the war, of course, private credit. So those names are still challenged. And obviously, we're monitoring the policy response. We've had a good look at it over the weekend and late last week. So I think we're much closer to watching those scheduled dates, understanding how they deploy region by region. I think Australia's got a big day on Thursday on the data as well. So for long only, again, I think continuing to look at that real economy asset. I think the opportunity in the ags is strong into the seasonality improvement in May. And so, just in closing, to Stephen's point, you can manage that volatility to a degree, but it has to go somewhere, or it ultimately will come out somewhere else. Now, certainly, if they're reducing significantly, albeit gradually, the Fed's 40 billion a month, and if the TGA needs to get back to 900 by end of June, then obviously that is money coming out. Now, I think looking at where the market is now, where it'll open, I suspect we will keep a close eye on that. Obviously, the QRA is the end of this month. We always focus on that as well, so we'll do some more work on that. But critically, what we'll do, add to the long form note, we'll add the schedule. And again, I think it is used predominantly and significantly when he's starting to lose the market. Now he's got to move back at 70 from 115. He is no question trading it. He also recognises that he can't overplay it, or tries not to. So we'll keep an eye on that and add that to the long form note. In addition, and I agree with Steve, great work by the Matt and Nick. And again, thanks for your time. A little bit over time today, but as you can appreciate, a bit to get through. Stay short in the active books on those energy names. I'm still with it along the week, still short the Japan, Australia, and Germany. I did take some off on the way up, but added into the 2nd of March, as you saw, use the 2nd of March as a critical pivot. Thanks again for the week, and we'll update, no doubt, throughout the week.
Have a good week.
Cheers, guys.
Thanks, Andrew.
Thanks, everyone. Have a good week.